Welcome to Macro Minds, where I talk to economists and other experts about the issues of our time. Thank you and welcome to Macro Minds. Today I'm joined by Mickey Levy, visiting fellow at the Hoover Institution in Stanford, the longest standing member on the Shadow Open Market Committee for Monetary Policy, and a Wall Street Journal contributor. And Mickey, this is now your second time joining me on Macro Minds. I just remind our audience that we go way back, good 10 years now. So thank you so much for taking this time and joining us.
My pleasure.
So, if you're paying attention to global markets and the economy at the moment, no guess as to what we're going to be discussing today. So I'm gonna just start with a somewhat general question. So, would American living standards have been higher, Mickey, if it had not embraced free trade over the past few decades?
Look, free trade is the gold standard, and the U.S. advancing its continued economic growth and prosperity is a reflection of free trade. Not exactly free, but free trade, taking comparative advantage, and taking advantage of those capital inflows to finance technological innovations. And so in the current broader discussion about tariffs and President Trump's effort to reduce the trade deficits and bring manufacturing jobs back to the U.S., it's wrong on every account, and it would be a huge negative. And Kallum, what's so striking is it stands out as an issue that almost all economists on both sides of the political aisle agree.
The question for me is, suppose we just take a step back. Suppose we were to make Donald Trump's case for him here. Let's steelman the argument. What's the motivation behind these policies? And can you give our listeners an indication of why the trade balance seems to matter so much to this administration?
Kallum, I'm trying to be even-handed. I could perhaps justify tariffs or barriers to trade with China, but that's for international security reasons. There is no justification at all for the tariffs that Trump has directed with Canada, Mexico, the UK, Europe, Japan. It makes no sense either from an economic standpoint or from an international security standpoint. And I would note that Trump, you go back to the 1980s, and he still held these views that bilateral trade deficits and aggregate trade deficits are bad, and they should be eliminated. Back in the 1980s, he held those views, but he was bashing Japan instead of China. So he has these long-standing views that's really simplistic and economically wrong.
He seems to maintain the argument that any deficit in good, and it's mainly goods trade here, we're not really discussing services trade at all, which is of course where the US runs a large surplus, is the result of some distortions to trade by their trading partners. I mean, is it just to say that he mistakes a deficit or a surplus on the goods trade balance as a profit or loss on a corporate balance sheet? Is it as straightforward as that?
Well, firstly, he does not understand the services side of the economy. And as you just pointed out, the U.S. is a significant exporter of services. Also, he doesn't understand the benefits of the capital inflows into the U.S. that are part of the trade imbalance, and those capital inflows have historically been a major contributor to U.S. advancement. You go back to the US industrial revolution, which came a little after the UK's, and say from 1865 to right before World War One, say 1914, and the US consistently ran a trade deficit and used the capital inflows to build out its industry. And in this post-World War II second era of globalization, the U.S. has run a persistent trade deficit since the 1970s, except for right around the recession of 1980 and then a one-time 1990 or 91. And it has used those capital inflows to build out its technological advances. And it's really a head scratcher how the Trump team buys into archaic notions that have been clearly refuted, but they stand by them. And then we'll get into this, but the bigger head scratcher is why nobody on Trump's team in Congress are not standing up and say, wait a second, let's use some common sense.
Just take us through the mechanics here, because I think there's a disconnect between, for the ordinary voter and apparently for the administration, between this deficit on goods, which looks like a loss on an income statement, but then economists make this claim that on the other side you see all of these capital inflows. So talk us through the mechanics of trade a little bit, please.
So listen, let's admit it as economists, international trade is much more complex and nuanced than simply talking about domestic consumption and investment and aggregate demand. It's just more complex. But basically, you're right. The U.S. Tends almost year after year, its investment exceeds its savings. And of course, think about the sources of savings. Household saving, business saving, that is retained earnings, and the government's dissaving, that is deficits. So there's this, we have always had fairly healthy growth in investment. So that the mirror image of that is, we take advantage of purchasing goods from overseas that are produced more efficiently and at less cost overseas. And so they're the mirror image of each other. President Trump and his team are correct to the extent that many foreign nations subsidize their production in various ways. They have tariffs. They subsidize production to give their producers a cost advantage, and Trump would like to break those down. But the whole thought of having everything in balance really doesn't make any sense. And this is just illustrated by Trump's vision of going back to when the U.S. was manufacturing king, right? In the 1950s. If in order to achieve that, in order to bring jobs back home and go back to manufacturing, that would reduce productivity significantly. Right. Yeah. And the environment going forward is technological advance in information technology and services, and you can't neglect that, and Trump is to a large extent.
And the reduction in productivity comes from this regression. You have to take workers. The US is pretty much a full employment economy. Capital is almost fully employed within the economy. You have to take workers and combine them with capital at a lower value add. it's slightly extreme, but you take lawyers and consultants from their desks and you put them back in factories. Right? Their
But there,
value add, their productivity is low. That's the argument? Is that right?
well, but there's another critical element. And that is when a country erects tariffs, imposes tariffs to protect some of its domestic industries, that shields those industries from competition. And the result is monopolies, rent-seeking, and inefficiencies and lack of forward advance.
That's right. And the export subsidies that Trump proposes, combined with tariffs, are a recipe for a much less dynamic, much less lean, much less profitable U.S. economy in the long run. And the companies they hit, let's assume that the tariffs in some form or another stay, but the companies which they will hit the worst are America's biggest, best, strongest companies. And the thing that's unique, we talk about the Mag 7, the big tech companies, but the way I think about these they're the most internationally optimized companies in the world. At every single level of production, they couldn't choose a better place on a cost and quality basis. So to say, well, you're going to come back to the US, it has great factor and natural endowments without question, probably unmatched. It has a well-trained, well-educated labor force, but still to bring that back to the US implies less profit, less quality, higher prices, and ultimately, which is what the market is telling you, companies that should be valued at lower levels.
Yes, no, that's right. So Callum, I'm smiling because here I am in Palo Alto, California, and I'm within 3 miles of the headquarters of Apple and Google and Meta and dozens of other advanced companies that are developing AI and things that it just oozes out of the woodwork. They benefit from inflows. And to go back to an era where the US was the manufacturing king makes no sense. So consider the following. The US's biggest, it imports the most from Mexico, Canada, and China. Let's put China aside for a second. Both Canada and Mexico, 80% of their exports go to the US. And if you take, for example, Mexico, a large portion of those exports to the US are intra-firm transfers. And companies of US-based companies, those companies have increased their efficiencies in so many different ways. And to turn your back on makes no sense. And you mentioned earlier that the US, the labor markets are pretty well balanced, pretty efficient. They have benefited from technological advances. If you were to force, as Trump is trying to do, force onshoring, there would not be sufficient labor. And then you get to this immigration issue. There would not be sufficient labor. And then, somebody involved in AI would say, and when that production is onshored, it's going to be much more capital intensive using robots rather than labor. So in a sense, it's really a head scratcher, which seems almost delusional on this. Now, from an economics point of view.
That's right. So give us a framework for thinking about this. So actually, let me just to spell out where we are. At the moment, we have a 145% tariff on Chinese goods. The Liberation Day tariffs have been paused across the board for 90 days. We're almost a week into that 90 days, so we still got a ways to go. There are some exemptions such as autos and autos import autos parts, which are tariffed at 25%. We've had some exclusions, including semiconductors and chips. That was the news overnight, but that's subject to this US Commerce Department probe. So, tariffs there are going to be forthcoming. But we're staring at a significant average tariff, say around 20%, which is the highest it's been in 100 years. And in all likelihood, assuming that there's some basis to the objective of the administration to onshore, which implies some permanence to these tariffs, whether they come down for some countries, go up for others. We're staring at a higher US tariff environment, at least until January 2029, in all likelihood, which is when Mr. Trump's term ends. So give us a framework to think about this economically, Mickey.
Kallum, here it is. And you've described how things are a moving target. But right now, where we stand, Trump has assessed 145% tariffs on Chinese goods. You still have the tariffs on the 10% across the board, and you still have tariffs on steel and aluminum, most of which is imported from Canada and Mexico. Okay, so let's take a number like you just said, 20%, and those are tariffs on goods. Right now, the U.S. imports a little over $3 billion in goods. So that's $600 billion. Now, what I would do next with that, Kallum, is say those tariffs should have a larger negative impact on the U.S. economy than would a tax increase of the same amount for two reasons. Number one, the tremendous amount of uncertainty created by Trump's erratic behavior. And you see that, it's interesting, if you look at, for example, the Bloom-Davis economic policy uncertainty index, it's gone sky high, and they've done some empirical work, and that would harm both consumption and industrial production, according to their estimate. The second reason is just the heavy reliance on global, production processes and global supply chains. So I put a pretty high negative multiplier on that. So it's more negative to the economy than a tax increase of the same amount. And so with that, I come to the conclusion is to be spread out over a certain amount of time, a couple of years, and that would be enough to generate a recession, a mild recession, even though the U.S. is, and another point there, getting beyond the U.S., it would generate a downturn in global trade. So if you look at total global trade volumes, they had been flat, but in the last year they've tilted way up 100% due to China's dramatic increase in its exports to try to offset its weak domestic demand. So you would have probably a recession in the U.S., even though going into it, the U.S. You don't have a lot of excesses. Labor markets are in good shape. Business inventories aren't too high. So you would have a recession.
But does that recession reflect a reduction in supply potential, essentially? No. Kallum, think of the following, and I don't want to use economic jargon, but it would be exhibited as a shock, a negative shock to supply, to production processes, obviously. And because of the uncertainties and some of the higher prices to be passed on, you would also shift in the aggregate demand curve. So you'll get a shift in both supply and demand. Now, I would also, and this is critically important, let's say that were the scenario. I would also reduce my estimates of potential growth by a little bit, maybe 0.25%, where you say that's nothing. Well, in real terms, on a 20 some odd $1 trillion economy year in, year out,
you multiply a quarter, you take a 1/4% per year off, and it compounds, and you can actually um, um, make estimates of how it's going to lead to lower productivity. And keep in mind, over the last, since 2020, the general price level has gone up like 25%, and US consumers are just worried. They're just tired of the higher prices, and businesses may not be able to pass on as much as they think. So my feeling about this is when we get back to the hit to nominal GDP growth, to current dollar spending, it hits the real economy and only has a fairly minor impact on inflation. But when we talk about hitting the real economy, that means US business margins are going to get squeezed. Their profits are going to go down, and that's why the market's been lowering their valuations of these companies. And what all that adds up to is businesses are going to have less free cash flow to invest, and they're probably delaying hiring. But that's just, Kallum, that's just one scenario. There are other scenarios that could occur also.
To what extent does a bad market outcome near term contain some of the longer run economic damage?
Well, certainly the weakness in the dollar reflects, concerns about the US government's credibility and reliability.
It's not unusual for the US to go through a soft patch. It's even not unusual for policymakers to make a mistake. But when the US normally weakens, it usually provokes a big risk-off move in markets. And then we see two things. We see a shift away from risk assets. Check, we've seen that already. But then we typically see a shift into US Treasuries, the ultimate safe haven, ex-gold. It's the deepest, most liquid government debt market. And then you typically see the dollar appreciate. This time around, we're not seeing that. We're seeing, on some days last week, rising US bond yields and a weaker dollar, which suggests a de-risking of US assets. Actually, the only comparable situation to that is September 2022 in the UK, when the market grew concerned about the trust budget, where you had this non-textbook response of currency to higher bond yields. And I think that's the thing that is most concerning in the recent developments in markets.
Alan, before we get to that, you mentioned, is there a possibility of a more positive outcome? And let me just briefly say, there is some probability. During the Trump first administration, once he started in on tariffs, he continued with tariffs. But he tried to negotiate a deal with China. So the positive scenario is a lot of foreign countries, their leaders, and this is Trump's hope and strategy, even though I don't think he's a very good strategist. The hope is, the leaders will come and kiss his ring and offer to reduce their tariffs, to reduce some of their subsidies that advantage their industries. And then you end up with, say, 10% across the board tariffs. And that could still generate an economic slowdown or recession. That's a possibility. But now let's consider your bringing up the dollar. And I would say this is the biggest risk. And let me summarize it by saying the way the markets have behaved in the last week with higher US Treasury bond yields and a lower dollar, this to me reflects market concerns about the credibility and reliability of the US government. And this is extremely disturbing. So what markets are saying here is, if you take Trump at his face at face value. He wants to not only raise tariffs, but he wants to redefine the global order, with the US playing a much more isolated role and cutting back contributions, like for defense, for USAID to developing nations, to recast the world order. And this is extremely disturbing to global governments and investors. Keep in mind, 1/3 of all US publicly held debt of, say, $25 trillion is held by foreigners, foreign sovereign central banks and private investors. And if they lose credibility, the dollar goes down, and then it hits, Kallum, it hits the US's weakest link in macroeconomics, and that is its very high debt, the rising deficits, and the need to finance that debt. So let me take a broader perspective on this. The US has been the leader of the world, but it shouldn't presume that it has a lock on that. And Kallum, it's just like any other institution. A football team or a basketball team or a university or a government or a leading company. You have to have a strategy that is credible and builds on that franchise. You can lose your franchise value. I know you guys don't play American football, but consider an NFL team that, you wake up the next day and, the owners have traded away the superstar quarterback and the key receivers, and announces that, we're going to cut everybody else's on the team, their salaries by a half. So what happens to your franchise? And once you lose that franchise value, it's hard to regain it. And so let me get back to the US. The US has this, exceedingly high budget deficit that has to be refinanced, right? And once again, 1/3 of those publicly held treasuries are held by foreign institutions, and a loss in credibility is exceedingly important. And if this were to continue, Kallum, if this were to continue, then once again, it could impinge on the treasury market, which has always been perceived to be the safe haven for the world during crises globally, even during the US financial crisis in 2008-9 that the US caused. There was a rush into treasuries, and if you lose that, it could take on a new dimension of downside risk. I put a low probability on that, but you're dealing with fire here. The one issue we have not discussed that I should have is the balance of powers in the US is also exceedingly concerning now. I mean, the US government was set up with the executive branch, the legislative branch, and the judiciary, and now over the last decades, you've had the Congress abrogating its responsibilities. It is mandated to impose tariffs. And so you can ask the question. So in recent administrations on both sides of the political aisle, you see the president stepping up power and taking power away from Congress. And of course, Trump is an absolute extreme here. So you can ask the question, what is Congress doing? Why is it not stepping up? And let me be more specific. Why aren't Republican leaders in the House and Senate stepping up and telling Mr. Trump, no go, you can't do that. That's our responsibility. And so this folds into this issue, Kallum, of
when are the midterms? Are the
credibility.
midterms next year in
Yeah,
the US? The midterms are next year. So, and the polling ahead of the midterms for the Republicans doesn't look positive, to say the least. To what extent will just good old-fashioned political pressure, worries about losing an election in the midterms, force Republicans in Congress to say, actually, we're going to try and challenge some of these executive orders and return lawmaking on the issue of tariffs to Congress?
so when I think about the balance of powers and how they were set up.
And let me just add, sorry, that the assumption by Wall Street economists, city economists at the start of the year would be that we would sort of have a repeat of the first term, where on tax policy, the tax cuts, and on deregulation, you would get most of the good stuff, and then this check and balance would operate in such a way to contain some of the excesses on trade. That's exactly what we have not seen so far, and I think that partly has caught markets out.
Yeah. Okay. So when the U.S. system was set up with balance of powers between the executive branch, the legislative branch, and judiciary, financial markets weren't very mature. And so right now, while Congress is sitting on its hands and not pushing back, and the judiciary is kind of pushing back mildly, but no major cases come up. The real checks and balances against Trump's power, central command power, has been financial markets, and particularly the stock market, right? And the upcoming elections. So maybe Republican leaders in Congress will, as we get closer to the midterms, will go to the president and say, if you want to destroy the party, keep doing what you're doing. Last week, we saw, a lot of people said President Trump blinked. I wouldn't use that term. I just think the pain of the stock market going down just exceeded his threshold, which, Kallum, is no way at all to conduct policy. It's appalling.
And where does the budgeting process come in all of this? We were so focused on tax policy at the moment, on tariff policy. The Congress is currently working through a huge budget.
Yeah.
Can you give us a little summary of the key aspects of that and where we are in the process, and what that might actually mean in context of these tariffs?
Okay. Yes. Okay. So before I go there, you were right earlier on. Trump's first term, 2017, began with deregulation and discussion of tax reform that ended up being a big tax cut. And the economy in the first year and a half of Trump's first term, everything accelerated. Confidence was up. Consumption and investment were up. I mean, accelerating. And then he started in with tariffs through executive orders, just like he's done recently. And once he started on the tariffs, the rate of growth of consumption and investment and domestic demand eroded. One of the differences in the first Trump term is the Fed was gradually raising rates. And then finally, when things got so weak, it started lowering rates in 2019. the stock market, you know, it went through some short fits and starts, but ended out appreciating. This time around, of course, in the last year, the Fed raised rates and is on hold. But now he starts out with tariffs and threats to the government. Deregulation is moving along, but it's kind of taking a back seat. And now you have the House Ways and Means Committee that originates all tax legislation, and the Senate Finance Committee have worked behind the scenes, and they have come up with a significantly large tax package and spending package, which extends most of the 2017 tax cuts, just extends them, and incorporates a lot of spending cuts. And this should, I expect, and I've been in touch with some people on those committees, I expect the legislation to be put together in detail and be under debate by mid-May. Now, extending the tax cuts, Kallum, basically means taxes aren't going to go up a lot, but it won't have the same positive stimulus that the actual tax cuts had in 2017 and 18. So it's just extending the current tax structure and imposing some significant cuts.
My final question here, with all of the challenges that we see on the government side,
yes,
where does this leave the Fed? This leaves the Fed, I think, with some very difficult and unusual trade-offs. Listening to your earlier point about, going back to our charts for economists, so the kind of shifts in aggregate demand, aggregate supply, it's, in all likelihood, with the confidence effect, even if we get a bit of a price level shock near term, this is unlikely to be an inflationary shock. But to what extent would the Fed have the confidence, or even dare risk perhaps looking captured by fiscal policymakers by leaning too aggressively, too early against any downside risk? I mean, does the Fed just need to see the labor market crack before it can cut rates?
Okay, so Kallum, last month I had a piece in the Wall Street Journal entitled Tariffs on a Collision Course with the Fed's Dual Mandate. And the Fed is really on the hot seat now. Because if you think about it, monetary policy is an aggregate demand tool.
Right.
It should not be responding to a negative shock, but it will. Now, the best thinking at the Fed now is, to the extent the tariffs, boost prices, if the tariffs are just a one-time, increase in tariffs, that should be temporary, work its way through the CPI in a matter of months. The way you get a permanent inflation out of this is if the higher prices trigger a rise in inflationary expectations, and it becomes embedded in the wage price decision making in the private sector. Meanwhile,
and just to add a point there, when you see economies where policymakers lose credibility, you start to see unusual developments. It is possible to see real GDP fall and inflation rise. It's not what is.
So it's this collision course. Meanwhile, the Fed is bracing for a sharp slowdown in the economy and maybe recession. They don't talk about it, but they're of course, through the 12 Federal Reserve Bank districts, they're talking to executives of companies daily, and they hear the bad vibes. Historically, Kallum, the Fed has responded much more quickly and aggressively to weakness in the labor markets and a rise in unemployment than it does to inflation. So my expectation here is, my expectation is if and when the economy weakens significantly and you start seeing some terrible employment reports, if at that time inflationary expectations are well managed, and here I would look at market-based rather than survey-based inflationary expectations, then the Fed would lower rates. But this really puts them on the hot seat. And let me just give you another point to make. In the current environment where you raise taxes and you raise tariffs, that reduces expected rates of return on capital, which reduces real interest rates, which makes the current federal funds rate more restrictive. Okay, and the lower real rates associated with the higher tariffs would lead the Fed to need to lower rates just to keep monetary policy where it is. Now, that's talking about monetary policy and how it may, and I do expect the Fed to use, that talks about monetary policy in a fairly conventional way. But what the Fed is also aware of is this outside risk of the worst case scenario where the Trump's antics lead to a loss of credibility, the dollar falls, and you have a crisis begins to bubble up to the surface in the Treasury funding market. The Fed doesn't want to have to step in. It has in the past. In March of 2020, the Fed had to step in and stabilize the primary dealers that distribute the bonds. The Fed doesn't want to have to intervene. They're actually thinking behind the scenes now of how they could change some of the regulations to allow commercial banks to own more treasuries. So the Fed is bracing itself for a conventional downturn, hoping that the higher inflation doesn't drive up inflationary expectations, but they're also thinking about worst case scenarios that
unconventional worst case scenarios.
Yes.
Oh, Mickey, I've thank you so much for being so generous with your time. In a sentence, my last question: what's the thing that markets are not paying attention to that they should be paying attention to, in your view?
That's a great question. Given, when I think of probabilities, scenario one, where it's a mild negative and you get back to 10% tariffs, that would be fine. A less worse scenario, which is where we are now, 25% tariffs, a recession, but the government's credibility doesn't fall apart. I put the highest scenario on that. We can live with it. And the market has started to price that in. The market has not yet priced in the worst case scenario, which I put if I put 10% probability on, where the U.S. loses credibility, and you have wholesale unloading of U.S. Treasuries, and Treasury yields start gapping up. The market has not priced that in. Like right now, if you consider like a U.S. Treasury yield, the 10-year Treasury yield today is like 4.35. It had been in the middle of last week, I got up to 4.5. If you think about that relative to expectations of inflation of about 2.25, that gives you an ex-ante real rate on the 10s of about 2.25, which is pretty much in the range. Let's say you start to see Treasury yields gapping up and the dollar down. The market has not priced that in and would have much further to adjust portfolios and valuations.
Well, that really is a serious risk to watch. Mickey, thank you so much for your time, and Hope our viewers, our listeners enjoyed this, and I look forward to speaking again. Thank you.